So this is basically Big Bailouts. It's a history of bailouts or a history of financial crises in the United States. I'm going to do it in very short order. I have two computers there. So the big thing is that you are interested in is holding the government accountable and getting good stories out of it. Now, again, I hope I do not talk down to you. Some of you have more experience, less experience, better memories because you're older, or no memories at all. But I'm going to assume that you're all intelligent, but that you don't have a memory of a history of the United States. And the book that I wrote is really the book that I wish someone had handed me when I had started at the Washington Post. I had to learn it all from scratch, which has its benefits too, as you're not prejudiced by other people. But, and of course, most of the scandals hadn't happened yet. But nonetheless, the precepts and the ideas were important. Just the fact that it's good for you to know that every single federally insured institution has to have a federal regulator, no matter who they are. You have to go and look and say, who is their federal regulator? So, and why are there so many federal regulators? Well, that's all happenstance. But I'm going to go through that in a brief history and hope that you find it interesting and not too boring. I find this stuff, I find finance absolutely fascinating, and it's where of course, where the money is. So some history. I don't know if you can see this. It doesn't matter if you can see some of the words. To me, some of the face tiles are overlaying it, but that's all right. It really does go back. Our history in the United States, financial history, goes back to Hamilton and Jefferson, and they were fighting over, I'm sure because of the musical, you all know, they were fighting over banking. But what they also more fundamentally, it was really a fight over corporations and the corporate form. And one thing that you need to remember as a citizen is that a corporation is something that only a government can bequeath. It's a designation, it's a status, it has many benefits, and only a government can give it, just like only a government can provide intellectual property protection. So, oh dear, I'm never going to. So that's an important thing to remember, and I'll get to that in just a second. But the important thing is that our fight over banking and whether it should be regulated and who should regulate it goes back to the beginning of the country, and we are still fighting about it today. So one of the most important things that I would say to remember whenever you're covering a financial institution is to remember that corporate governance, how it's run, really affects the structure. So, for example, Koch Industries, I'm sure you all know the Koch brothers, K-O-C-H, not Coke, like Coca-Cola. They have the largest private company in the world, but it's private. So they are not bound by the same disclosure requirements that, say, a publicly traded company is. Let me just make sure I don't miss anything here. I have two screens with the Zoom presentation. If this were in person, I'd be hopping around. It's hard for me to sit. So what are the benefits of a corporation? There are many. It can raise money more easily because there's the big thing about corporations, there's limited liability of the investors. The owners have limited liability. So the company can raise more money more easily because people know they can only lose their investment. Creditors can't come after their home or other assets. It's easier to buy and sell their stake in it. And it separates, the key thing is when it comes to financial crises, because financial firms, is it separates ownership from leadership. So the people running the company, as I'm sure you all know this, are supposed to be there on behalf of the owners, and the board of directors are supposed to be representing shareholders and keep it riding herd on executives to make sure that their interests align with the owners. Because once you separate ownership from leadership, the people who run the company versus the people who own it, you start to get into all kinds of conflicts of interest, including that the person running it will run it to their own benefit. So you have these benefits of being an incorporation, an incorporated entity. And by the way, this is what Jefferson was very skeptical of. He didn't want the federal government to bequeath the status of a corporation because he thought that when you hear it as cast as an argument over a central bank, the real question was, to have a central bank, you have to have an entity that's incorporated. And Jefferson was concerned about that power. And you hear people today arguing about the power of the Federal Reserve, our central bank. We finally did get one, but people are very skeptical of it. And that's when you heard Trump and his minion, Steve Bannon, talking about going back to the gold standard. You heard that for a while. And Steve Bannon, I'm sure Trump had no idea what was going on. He had Andrew Jackson, a portrait of Andrew Jackson on the back of his office, and he was pictured with it. That was all Steve Bannon. But Andrew Jackson was a foe of central banking, and he wanted to go back to the gold standard and all these things that, while maybe nice, we did that and it was chaotic. So anyway, these are still arguments that people are having today. And it's not just a theoretical argument. When people come into office and assume the role in the White House, it really affects whether they're going to do more or less oversight of the financial world that affects our lives. So now, why isn't this going? So here are the downsides of being incorporated. And why is this? Let's see. First of all, it can give management, I'm sure you all maybe know this, it gives management a short-term view. In the recent crisis, the mortgage crisis of 2007 to 2012, one of the sayings on Wall Street was IBG, YBG. Does anyone know what that stands for? I'm wondering. I know I got to go through this really fast. It stands for I'll be gone, you'll be gone. So people were, the separation of ownership from leadership meant that there was this focus on short-term profits and short-term results that in the long term were not going to pan out. In the long term, these loans were going to fail, but in the short term, they generated fees that made the balance sheets of the banks look great until overnight, they suddenly had to write billions and billions of dollars off as worthless or near worthless. So the thing to keep in mind is that for a financial institution, because most are publicly traded, and then we'll talk about the shadow banking industry like hedge funds, which are not publicly traded, the publicly traded financial companies have often a shorter term view. And there's also a uniquely inherent conflict of interest between financial institutions and their owners, their shareholders. And that is that I'm sure you've all heard this, that in theory, the purpose of a corporation is to maximize shareholder wealth. Now, when you do that in a financial institution, that can go against the interest of your customer, which you're supposed to be maximizing their wealth. And unless you have a legal designation as something called a fiduciary, if someone has a legal designation as a fiduciary, it's one of the first questions you should ask. Certainly, if you're getting your own financial advice, are you a fiduciary? If the person can't say yes right away, walk away. It means they're a financial advisor. If you're a fiduciary, you are a financial advisor with the added legal obligation to do what is best for your customer, even if you make less money. That is a really important designation to have. And so in a financial company, there is now, when you are publicly traded, you have this potential conflict of interest between maximizing your short-term gains to trigger your bonuses and your compensation versus doing what's best for your customers. So today, for example, you can walk in, if you walk in and you say, I want to invest in a mutual fund, and you do not have a fiduciary who's advising you, that person can put you into a mutual fund, can put your money into a mutual fund from whom they get a kickback. It's a legal kickback. It's called a 12B1 fee. You don't need to know that, but they get a kickback that's legal. They have to tell you about it, but for most people, they hear 12B1 fee and they think, what the heck is that? So they have to tell you about it, but they get a fee, and as long, and you may make less money than you would in a mutual fund that they could have put you in from which they would get no fee. So they have an incentive to put you in the one that earns you less money and them more money. Now, their only obligation under the law, if they're not a fiduciary, is to put you into a mutual fund that has a risk profile that matches yours. So if you are risk averse, they can't put you into penny stocks, which are highly risky. But if you want more risk, they can put you into something. So their only obligation is to put you in something that matches your risk profile. So you just should be aware that, and I always keep in mind that these companies have an inherent conflict of interest that is unique. The financial world has a unique conflict of interest. other corporations, if you make cars or sell clothing, you may want to sell cheap clothing and cheap cars. That may be your model, but you also might have an incentive to say, okay, if we sell bad cars, we can only do that for 1 quarter and people stop buying our cars. So you have some incentive to at least do a good thing. But if, as a corporation, and you might have that same obligation as a financial company, but again, the product itself is, has an inherent conflict of interest. You maximize the financial wherewithal of your customer or the executives that are running the company. Now, I'm going to give you a 1 minute. This is several hundred pages in my book, but through most of the history of the United States, the financial industry was in chaos. We didn't have a central bank. Some of you may know this, but I'm betting you don't. I certainly didn't. We didn't have a national currency until the Civil War. So up until believe it or not, until the Civil War, the 1860s, the United States, we had a couple attempts at a national currency and a central bank, but they ended up, I won't go into that whole history, but we ended up with no central bank going into the Civil War, and Lincoln and his Treasury Secretary, Samuel Chase, had no money to fund the war. So they had to create a stealth central bank, which was the national banking system that you now see. First Bank of Chicago, my favorably named bank is the 3/5 Bank of Cincinnati, which always makes me think something's missing from that bank because it's a fraction, not a whole thing. So you have the first bank, the second bank, if you've seen that around. The national banking system was created in the Civil War by Lincoln to fund the Civil War, and it gave us our first permanent national currency. Until then, it was like before the euro, traveling in Europe. I'm sure you don't remember traveling in Europe before the euro, but it used to be you had to change your currency every country you went into. And traveling in the United States from state to state, you would have to exchange, believe it or not, your currency. And there were 9,000 different paper denominations in the country prior to the Civil War, believe it or not. It was utter chaos, and you can imagine bogus notes were rampant. So counterfeiting, that's the word I want. Counterfeiting was rampant, and it was a big mess. It was just crazy. And there was none of the financial landscape that we think of today, the regulatory landscape. So Americans had a crazy currency that was always losing value. Hundreds of banks failed a year. That was routine. So finally, in 1914, we get a central bank. And we get, the Civil War brought us a national currency, but it was a crazy one tied to, I won't go into why, but it was nutty. It didn't really work. So finally, after a huge financial scandal at the turn of the century, Congress said enough, we need a central bank that can give a permanent, well-functioning currency and also some oversight of our financial system. So we got the central bank. Now, the problem with that was the Fed didn't know what it was doing. You've heard about the crash of 1929. I've gone from as the founding of the country, I'm now in 1929. When the run-up to the crash of 1929, interestingly, one of the reasons that the 1920s was so go-go is because they had just come out of a pandemic, not unlike our own. There had been the pandemic and there had been World War I. People were very eager to forget all those things. And so they wanted to, suddenly the American public became, for a variety of reasons, which I go into in the book, but people became fascinated with the stock market. And many people, there was too much money that was lent out to borrowers to invest. And that's one of the key, I'm going to talk about every crisis I go through, and I'll go through them pretty lickety-split. I'll talk to you about things to look for. And one of the things that I have identified is something called easy credit. And it's not just easy money, but it's easy credit. And I define it very specifically. I found this very useful as a reporter to me over the last several decades covering this stuff. To think of easy credit is credit. Corporations, people borrow money. What's easy credit? It's when there's too much money available to borrow to chase too few good investments. So in the run-up to the 1929 stock crash, you have what has happened ever since in every crash is people had access to too much money to invest in risky things. Because when people have borrowed money, they are more likely to invest in risky things rather than if they have their own money at stake, they'll be more conservative. Just like if you're publicly traded, you're using other people's money. If you're a partnership, you are using your own money and you'll be more conservative. So publicly traded companies and anyone who can get access to lots of borrowed money without much oversight is more apt to invest in risky things once good investments dry up. And so that's what happened in the run up to 1929. It's not that there were no good investments. It's just there was more borrowed money, more money that people wanted to borrow and invest to make a quick buck than there were good investments. And you had a bubble, and then you had the crash. And then through a series of missteps by the new central bank that had been created in 1914, we did have the central bank. That's the first big piece of our regulatory system was put in place then. It didn't know what it was doing. So it allowed too much money to be in the system at the wrong time, and then took too much money out at the wrong time, especially after the crash, and it caused the Great Depression. When I was growing up, people didn't know what had caused the Great Depression. We now have a really good idea, not the least of which is because of Ben Bernanke, two Fed chairmen ago, God, I can't believe that, two Fed chairmen ago, who was a scholar of the Great Recession, the Great Depression of the 1930s. That was his scholarship at MIT and at Harvard. And when he became Fed chairman and was Fed chairman during the 2007-2012 crisis, which until this current crisis now with the pandemic was the worst since the Great Depression, all of his knowledge of what had caused the Great Depression in the 1930s really came into play. So what happened in the 1930s is we had the biggest, baddest depression that we have had, still probably worse than what we're going through now, although that will remain to be seen. And what happened in response, unemployment went up to 25%, which is probably the number one marquee number that you want to keep an eye on, obviously, is employment. It drives everything else. That is what gave Congress the impetus to put in the rest of the financial regulatory apparatus and landscape as we know it. It created the Securities and Exchange Commission. I mean, think of it. Before the Civil War, we had no currency or central bank. Then we got currency, but a crazy kind of currency. And so it wasn't until in the early 1900s that we got a more stable, rational currency system and a central bank. And it didn't know what it was doing until the 1930s. And then we didn't get the rest of the apparatus. So before the 1930s, we had no accounting standards. In many cases, there were no anti-fraud provisions for many things. So when you hear the phrase blue sky laws, I always wondered what that was. Those are state securities laws that were put in place prior to the 1930s is when they began, because there were no federal laws regulating Wall Street, essentially. There were none, or very few. So you have the 1930s, suddenly you get the Securities and Exchange Commission, they strengthened bank oversight by the regulatory agencies, and most importantly, you get the Federal Deposit Insurance Corporation. You get this idea of federal deposit insurance, which changed everything because it put taxpayers on the hook. Because prior to this, there had been hundreds of banks failures every year, and the government didn't come in to bail anybody out. So after the 30s, before the 1930s and after the 1930s, and the 1930s apparatus really established that Hamilton had won. You were going to have a central bank. You were going to have oversight of the financial system, but there was always this tension about how much you should have. We are the only country in the world that has this bifurcated bank regulatory system of state chartered banks and federally chartered banks, and it has caused chaos forever because we have it. But on the other hand, as a reporter, you can use that to go to state regulators versus federal regulators, because they're often at odds with each other, and you can, I wouldn't say play them off each other, but if the feds are not doing anything, you can often the people who are going to feel it are the state regulators, so you can go to them and say, what's going on. The state regulators, bank regulators, the state corporation, there's always a state corporation. You can have a federal charter or a state charter as a corporation, and there's offices that regulate that, by the way. So in exchange for getting this designation as a bank, as a corporation from a state or federal government, that government is giving that designation of a corporation, limiting its liability, making it easier to raise money, all those things, gives it that designation. And in exchange, in theory, the government's supposed to be making sure that that corporation isn't doing anything that harms the population. Now, interestingly, as an aside, corporations at the beginning of this country, people were very skeptical of them and limited them. They were limited in time frame. They had a 20-year charter. They were limited in purpose. There was one thing they could do. The financial services industry, I won't go into detail, but it is true, through decades, by the 1930s, had made the corporate form what it is today. Even regardless of whether you were in financial services, the financial services industry created the corporate form. It exists in perpetuity, exists forever. A corporation can do it, make whatever it wants. It doesn't have to get prior approval. And in theory, it exists forever unless it files for bankruptcy. So so that happened. We had that big depression, big bad depression in the 1930s, which we really didn't get out of till World War II. But we got all of these things. And the precept was that you have to have transparency and accountability in the financial markets to really make them free. And who can do that? Who's the honest broker in that? It's the government. So that's where we get this idea. And we've been playing with what's the right formula? How much government do you want? It is when the government comes in to create a level playing field and make sure everyone follows the same accounting standards. Is that if you're a libertarian, you may not want the government to even do that. But investors like it. They like uniform accounting standards. They like to have anti-fraud provisions. They want to be able to go to court and sue when things go wrong. So that's where we get that really since in the 1930s. And deposit insurance. This is from Jimmy Stewart. It's a Wonderful Life. If you've not seen that movie, see it. A, it's an American classic, but B, it also really explains how deposit insurance works and why the interplay of all these agencies during a crisis. And it can be somewhat intricate. The big thing is you want deposit insurance is really not there. You think of it as something to protect the individual so that if a bank goes under, you know that you're safe. What you've deposited in a bank is safe up to a certain amount. It does do that, but you're a sideshow. The reason for federal deposit insurance is to calm individual investors so they don't have runs on banks and demand their money the way people here are in this fictionalized version. You want to prevent that because you want to maintain, because that causes economic chaos. So deposit insurance is really there to provide stability for our system, our economic system, not the individual, even though it has that collateral benefit. Now, starting in the 1930s, the other thing that happened in addition to this apparatus was this idea that we were going to cordon off and put the financial services industry, which at the time was like these horses, everything was jumbled. You could be one-stop financial shopping, you could sell securities, you could be an investment bank, commercial bank, realtor, insurance company, all under one roof. And Congress said, no, that caused problems. There were conflicts of interest. We're going to cordon you off into these little side corrals here, and everyone's going to stick to their knitting. And everyone did, starting in the 1930s for 50 years. And now I'm going to fast forward to the banking crisis of the 1980s, which is what I really cut my teeth on at the Post. That was in full bloom. That remains, by the way, the 1980s banking crisis, which is often known as the thrift crisis or the savings and loan crisis. A thrift or savings and loan is just a bank. It's a commercial bank that used to specialize in making mortgages. That's all it could do. And all it did. And suddenly in the 1980s, we didn't need those anymore. And there was this big crisis, which I'll talk about in 2 seconds. But there was relative calm from the 1930s to the 1980s. And the two things that upended, everyone was off doing their own knitting and no one could be in each other's businesses. And there was a cap on interest rates. Banks could only pay you so much. So banks didn't try to compete with each other to offer the highest rate. And everyone was kind of doing their knitting. And then what happened is you fast forward, starting in the 70s, 80s, you had oil shocks, which caused inflation. Believe it or not, inflation was so high that interest rates, the prime rate, it's hard to imagine this with our zero interest rate right now. Interest rates, the prime rate went up to 21.5%, believe it or not. 21.5%. Can you imagine earning double digits on your savings? So we had rampant inflation and computer technology. And what it did is it really upended. I won't go into the details, although they are in my book. It upended the financial services industry and suddenly made all these separate industries, which had been operating in their own little corrals happily. It suddenly made them start to want to get into each other's businesses. Commercial banks wanted to make home loans. Commercial banks wanted to sell investment banking products, and all these things that had once been under one roof prior to the 1930s. Now the fad of the day in financial services, everyone wanted one-stop financial shopping. Sears Roebuck, you guys don't remember. Do you remember Sears Roebuck? Or know what even Sears is? But every company and their mother wanted to get into financial services. And even today, every company that you see has a huge financial investment component. Apple, for example, is sitting on a huge amount of cash. And it has a whole department that doesn't just make computers, but thinks the way an investment bank does about how to invest Apple's money. So in many ways, all corporations, major ones today, are part of Wall Street. The real deregulatory actions, you may hear that it came from legislation. It didn't. It happened de facto on the ground because of forces outside of anyone's control. Just trust me, the banking scandal of the 1980s began through no one's fault. We just didn't need these specialized banks anymore, and they needed to be closed, which would have cost about $50 billion because of that deposit insurance. Remember, deposit insurance that had been put in place in the 30s, the government had an obligation to pay off depositors. So it would have cost about $50 billion. Reagan and Bush didn't want to do that. They had promised less government, fewer taxes. So they thought that the voting public would see a closing of these institutions, which a true free marketer would have said, hey, they're insolvent, let's close them, pay off depositors. Would have done, but Reagan, Bush said no, because taxpayers will look at it as a tax and we won't be reelected, so we'll keep them open. Anyway, it morphed, it changed from a problem of that was really no one's fault, things had just changed, into a scandal where you had these banks investing in commercial real estate and other things that they didn't understand. And the problem that had been a $50 billion problem because the Reagan and Bush administration tried to cover it up became a $500 billion problem because they didn't shut these institutions when they should have. As a reporter, my problem was I would go to my editor, and later on all the editors said, oh, we were wrong on mea culpa, but it was too late. I would go and say, hey, there's this huge taxpayer liability that's building up because you're going to have to close these sick puppies. You can keep them open for a while, but eventually you're going to have to close them once Bush wins. And Bush did keep them open until he won. He was vice president under Reagan, and then so for 8 years of Reagan, and then they kept this all under wraps during the 80s, and it grew and grew and grew, and they just got by the election, electing Bush from vice president to president, and then immediately on assuming the presidency, he said, oh, I forgot to tell you about this big problem, and we have to have this bailout, and here's some legislation. But I would go to editors and say, there's this big tax liability coming, and they'd all say, well, wait a minute, don't we have deposit insurance? Is anyone going to lose any money? Any customer? And we'd say no. And they'd say, well, then we don't care. Okay, well, you may get your savings back from your bank, but your tax bill is going to go up. So that was a problem. And so then one of the problems is, and one of the things you always need to look out for is when you talk about regulation or deregulation, is you need to think about rules and enforcement of the rules. And there's always those two components. And during the 1980s, one of the big problems that the government did is they deregulated. Reagan promised to deregulate. So he started to say, hey, you can do whatever you want. We can go back to this one stop. You can sell all these financial products under one roof. And really should have said, so we need more policing. We need more sheriffs to make sure you're not abusing that power. But instead, they had fewer sheriffs as well. And so what happened is this dream of owning a home, these institutions that had specialized in, motherhood and apple pie and got whatever they wanted under the guise of selling home loans, began to invest. I'll get to the KoolAid in a second. They began to invest in all kinds of things. One guy opened a branch of his bank on the moon. Here's a brothel. That's a prostitute in a bath. These banks were investing in brothels in Nevada, and they were one guy dressed up, and then this is some books were written about the crisis in the 80s saying it was I have a book featured there. I hope you can see it, called Inside Job, a competitor to my book, but that's okay. It's a good book, but it's about the crooks. But here's the thing. Once you have crooks coming into financial services, typically most financial service crises do not begin because of crooks. It begins because of well-intentioned people get into a jam, and they start to try to do things to get out of it. And that's when I'll go back to the KoolAid. They have, I'll talk about that in a second, because every crisis has KoolAid and you need to look for it. You need to look for easy credit. Is there too much money chasing too few good assets, which was the case in the 1980s? These institutions should have been closed, not given more depositor money to invest. But once the crooks come in, unless it's a Ponzi scheme is a crooked scheme that begins as a crooked scheme and ends as a crooked scheme. But most financial crises are not like that. Bernie Madoff is the most famous Ponzi scheme. He was taking money in and pretending to invest in it, and he didn't. But otherwise, what happens is it begins as a legitimate thing, and then it goes off the rails. Once the crooks start coming in, that's because they've identified it before the regulators have, that there's an opportunity for them to bilk the system. So once the crooks come in, the problem is already well established. And I go through all that in my book. And a Ponzi scheme is named after one of the biggest, most famous fraudsters from the 20s, who knew this very well. He was always looking for problems in financial services that he could go in and exploit. So once the crooks come in, you know that there's something bad. Now, and I call it the KoolAid. This comes from that, you guys, I'm sure don't remember Jim Jones? He had a cult and they all drank the KoolAid with him and committed suicide. But Wall Street has appropriated the term. And so in Wall Street, they call it the KoolAid. And it is the operating premise that later on proves to be ridiculous. No, so what was the premise in the 1920s? That stock prices always go up. Well, obviously they didn't. What was the premise in the 1980s, the KoolAid of the Reagan administration, is that the S&Ls, the thrifts, these sick banks can grow out of their problem by investing in things other than mortgages. Instead, they grew into a new, more expensive problem. And so you need to look for the KoolAid. It's kind of this ridiculous premise that everyone buys into. So now we get through the 80s.
Kathleen, I just want to, we're running short on time, so I want to make sure.
I know, I'm almost done. Any questions so far? Because I'm going to get now to this series of crises. Now I'm going to bring us up to date.
Okay, if you could move through those fairly quickly. So.
Okay. Maybe I've given you too much information. So the slew of crises followed the 1980s, and you may think the 1980s are really boring, but it is still the most expensive bailout. The bailout was $500 billion, all of which came from taxpayers. In the but the 2007 crisis, the potential tab to taxpayers was $24 trillion. 24 trillion, but most of that was paid back. Luckily, it might have not been, but it was. So even though the bailout of the 2007 was enormously bigger than the bailout of the 1980s, the 1980s bailout remains the most expensive for taxpayers ever in U.S. history. And it set the groundwork for a slew of other things. Hedge fund collapse, which was long-term capital management, Enron, I'm sure most of you have heard from Enron, and then the mortgage crisis of 2007. So you had this slew of crises that came in, all the groundwork of which was laid in the 1980s from deregulation. Now, the hedge fund collapse, long-term capital, was not a public company, but it's part of the shadow. You really need to know, if you're going to cover Wall Street, shadow banking industry, which is unregulated, but it's called shadow because it's operating, it interacts with the regulated, and when I say regulated, I mean taxpayer insured. That's what deposit insurance is. This all goes back to deposit insurance. Those entities, they interact with hedge funds and the shadow banking industry. So if the shadow banking industry went on the skids, government would let it fail. Why doesn't it let it fail? Because of its intersection with regulated entities that do have a taxpayer liability at the end of the day. So that's why long-term capital management, this famous hedge fund, nearly brought down the economy, and that's why it was bailed out. The mortgage crisis of 2007, you need to think the two biggest bailouts in U.S. history occurred on the watch of the two most avowedly free market presidents who would, before they began, would have said, I'm never going to bail out industry. I'm a free marketer. If you go into insolvency, let them fail. You live by the capitalist sword, you die by it. The two biggest bailouts in U.S. history occurred on the watch of Bush 1 and Bush 2, and that's because they were not willing to let this essential component of our economy, the financial services sector, fail, because it would have brought everything else down with it. Now, Enron is really interesting because it's the exception, even though it garnered a lot of the headlines. Millions of people lost billions of dollars, but because it did not pose what's called, and you need to know this term, systemic not systematic, but systemic, a risk to the system. If it doesn't pose a risk to the system, it's not going to be bailed out unless someone's doing helping their buddy. So you need to know the difference between bailouts and rescues when they come in for when the government comes in for temporary rescue, which the Fed often does, versus a bailout, which means it's a treasury operation, U.S. Treasury, not a central bank, and they're coming in with taxpayer dollars. I'll skip all this. I just want to remind you, and I'm sure you know this, there is no stupid question. What brought Enron down? It's because Bethany McLean, who's pictured here, at Fortune, a reporter, and she was talking to short seller Jim Chanos, who's pictured here, and they asked a very simple question of Enron, and they weren't afraid to ask it. The question they asked in January, I forget what year it was, in January of that year, Enron was the seventh largest company in the country based on several metrics. And they asked the question, we don't get it, how do you make money? And when they asked that question publicly, everyone said, yeah, we wondered that too, but we're afraid to ask because we thought we'd seem stupid. Within 6 to 8 months, the company was bankrupt because guess what? They weren't making money. So never be afraid. They asked the simple question, how do you make money? And they weren't afraid to be abused. Enron was trying to get Bethany fired all the time. They couldn't fire Jim Chanos, but he teaches the course at Yale Business School, by the way, that I teach at Johns Hopkins. He's a hilarious guy. But the two of them were looking at the balance sheet and saying, this is BS. We don't get it. How do you make money? So what is the next crisis? Well, right now, I think I don't have, right now, what I'm concerned about, that's my first book, is I want to say to you that this current crisis is very much like the 1980s crisis. It wasn't a crisis that anyone's doing on purpose. No one expects to have a pandemic. However, because of the way that this administration has handled things, there's already scandal. The first one is a headline from, I think, Reuters, Citizens for Ethics. Businesses linked, there was that payroll protection plan or policy, the PPP program, where Treasury gave out billions of our tax dollars and said, we're not going to say who we gave it to. Well, there's a reason they didn't want to say who they gave it to, because they gave it to a lot of friends and relatives of congressmen who didn't want it publicized. So it turns out that many of the members of Congress who voted not to have transparency in this loan program got money or benefited from it. And also you need to remember, let's see, under Trump, the first thing I noticed and began to say, oh, trouble ahead, easy, going to be good stories from this, I hate to say it, is under Trump, he began to fire many inspectors general. Inspectors general are there to make sure that money in different entities, different agencies are being spent on behalf of the public, and they're not. And the other thing that's happened under Trump is that they, even though many of the rules are still in place, even though they are rolling back many of the rules, they're also they've gotten rid of the police force. They're just not enforcing. That's the other side of regulation. Even if you haven't gotten rid of those, they're not enforcing financial rules, both against redlining, for example, that's discriminating based on your income and how you lend money. They're just not enforcing consumer protection rules. They've rolled them back. They don't like them. They're also they're going back to the ridiculous standards of giving loans that caused the 2007 crisis to begin with. Again, it looked good in the beginning and people said, but I'll be gone, you'll be gone. So we'll make this loan. We know it's going to fail in 2 years, but at the time it looks great. And I look great and I get my bonus and then I go off to a new job and it fails. The taxpayer's left with it. So one of the crises right now is how this money's being pulled out.
We need to get to questions. I know you just got a couple more.
Okay, this is the very last slide. And the last one I would have you look at is what is now being allowed under this administration to be offered to retirees. It's ridiculous. Trump administration just allowed hedge fund investments to be offered to retirees for their 401k. I guarantee you, I'll take you to lunch or dinner anywhere in the country if this doesn't prove to have lots of scandal in it, because this is just an easy way to rip off the vulnerable. Retirees should not be investing unless you're a billionaire already, in which case you don't need have a 401k. You have other investments. This is tailor-made to rip people off and be, so follow the money. I'm done. So I hope that was a concise history of banking. It's always been chaotic. Rules ebb and flow, but there's lots of public information. There's tons of public information, all because of those entities that were put in place in the 1930s. The problem for you is knowing where to get it. Last thing I'll say, the head of Enron famously said, Ken Lay, everything we did was in our public disclosures. That's true, but it was in such a convoluted way that unless you had someone telling you what to look for, you couldn't tell that that's what it meant. It took Bethany McLean and the short seller to really pour through the financials of Enron and say, this is BS. How do you make money? And it turned out they weren't. So, but there's lots of public information out there, as I'm sure you all know. The problem is getting to it. But a lot of it is computerized and, of course, now requires, big data. But big data, I would say, don't be afraid of it. It's just an old-fashioned way of putting numbers together. And thankfully, we have computers to help us. So anyway, questions?
So we have questions out there, either in the chat or audio?
I can't see the chat.
If there are, I'll let you know.
Okay, I'm going to stop sharing and just be here. So I hope that wasn't too fast, and I hope it gave people a sense that these crises, are, I don't want to say they're evergreens, but they're always going to occur as the philosophy of government changes about more or less oversight.
Okay.
Are there questions in the
Any
chat?
questions out there? Karen.
So how do you bring this down to the local level and, to businesses, and how all of this affects businesses now in terms of telling stories now?
Well, that's a great place to go and get stories, because one of the reasons that we know that the wrong companies got some of the largesse that was supposed to go to prop up small businesses is the small businesses never got their money. And so they were mad. Even Trump supporting small businesses said, wait a minute, all this red tape to get this bailout. I'm against socialism, but give me my government check. They can't get it. So they're suddenly mad. And then it turned out that led to then people saying, well, who did get the money? And it turned out it was these ginormous corporations. And some of them, I forget who now, but some of them actually, Ruth's Chris Steakhouse, I think, was one. I mean, they got the money. They had to return the money. So if you go to your local businesses and say, did you get the money? How are you doing? That's the place to start. And the local regulators, because they are the ones who are seeing the problem. Are you seeing more defaults in your state chartered banks? Are you seeing more problems? One of the things going into this crisis that we had is that there were, and I'm sure many of you have major corporations they're probably incorporated in Delaware, but they may have headquarters in wherever you are doing your reporting. And a lot of those companies before we went into the pandemic, there was a lot of stories written, including some by me, saying that there's this huge amount of risky corporate debt, basically junk bonds that companies, again, easy credit, they were allowed to borrow too much money for investments that maybe weren't great or were unneeded. And now that there's a recession, they're maybe going to go under. So you should look at the corporate debt load of any corporations that are based in your reporting area. That's one thing, because it could have national implications. And then, of course, all these federal programs from the current crisis, who's getting the money? Local business people want to talk.
So Kathleen, we have like 6 or so minutes, and we have 5 or 6 questions. So I'm going to read the questions that came in on chat, and if you could maybe limit your answers to 60 seconds or less, so we can try to get through these.
Sure.
A couple of them deal with documentation. What are the best documents, records you use to report on smaller banks?
Word of mouth. You need people to tell you what to look for. You need people that you could talk to on background, frankly, who don't want to stick their neck out but are angry about it. You need to find that person who has some moral compass. You have them tell you the state records, the state filings to look for. If it's a charity, my colleague at the Post who did all the charity work about Trump's charities have to file, I think it's called a 990, don't hold me, but they have to file forms. And so you go and you look at those forms. You find out what it is that entity has to file, and then you go look for it. And oftentimes it's computerized now. But someone says, sorry, I missed it. What's the current KoolAid? The current KoolAid is that we're going to get a vaccine and this is going to go away. And it might, but there's going to be some permanent structural changes to the economy, but that's one thing. For scandal, I think what is not, that a vaccine will not cure scandal-wise, is what happens to those risky debts after we've gone through a recession like this, and all those changes in what you can offer retirees, and who got the money. Who got the money? Who got this taxpayer-funded money from this program that was supposed to get us through this crisis? Those are going to be scandals. And the KoolAid is we're going to get out of this crisis when the vaccine comes. There's going to be a lot of hangover that is not cured by that.
Okay, we have another documents related question. What are your favorite, most informative documents and databases to mine at the state regulator level? And
again, I would go to the state regulators because their documentation is not as rigorous, but they can tell you when they start to see anomalies. So they don't have the state fight. Oftentimes, even state entities, when they raise money, they still have to file with the SEC, the Securities and Exchange Commission. So that's a great place to go. Even a privately held company, if they raise money in the stock market or bond market, it has to have a filing with the SEC. Best things at the SEC are proxy statements, not just the annual financial report, because in a proxy statement, that's when the lawyers come in and say everything that could be risky. So they really state it more baldly about what the risks are. And then you need to find out if your state entity has to have anything. First place to check is the EDGAR. It's called EDGAR. It's stupid, but it's the computer system at the SEC. Check that to see if your state chartered entity has anything filed there, and then go to the state regulators. Now, they may hate reporters, they may not be, but then go to the former state regulator and say, hey, when you were in office, what did you see, or who do you know? And competitors love to tell on competitors, as I'm sure you know, but the record keeping, I think at the state level, you really need people at the state level to tell you what's important and what you're looking at. And it's often true. I mean, there's a lot out there and you can get it, but sometimes you need to have someone tell you, just like someone told Bethany McLean, here's the footnote in Enron's financials. That sounds innocuous, but read it again and ask them what it means, and you'll see that's where they hid all their losses.
Okay. What's the single most important factor to tell whether a bank or financial firm is in trouble? It used to be risk-based capital, but I'm not sure anyone uses that term anymore. So
no, they do use that term, and they've lowered the risk capital. That's just the cushion that the bank has to go through before they can go to taxpayers or investors and then taxpayers. If they start to offer higher than market rates, if they start to offer, really offer a lot of programs to get depositors in the door, that may mean they're desperate. Look how often they go to the central bank to borrow money. They keep that secret now a lot. So a lot of this, I hate to say it, but a lot of it depends on getting sources that will tell you there's been a lot of activity. You know, all of you, there's 12 regional Federal Reserve banks. Get to know the officials there. Get to know the press person, probably who won't tell you anything, but you need to get to know these people before you're asking the tough questions. And the regional Federal Reserve banks often know what's going on in Washington, but out in the field. And they may know which financial institutions have come more often than not, more often than they used to, or more often than others, to get a loan from the Federal Reserve. That can be an indication they're stressed. First of all, they're all stressed in this environment. The question is who's going to survive. So on Wall Street, there's this saying of the boats, when in good times, the water, the high tide, all the boats are floating. It's in low tide that when you see who's swimming without a bathing suit. So it's this low tide where you're going to see who can withstand the stresses that they're now feeling. Again, it comes down to people telling you where to look, but you can start to look on your own.
And final question, try to keep, I know it's a big question, but try to keep it fairly short. Do the crises have an arc that we can watch for? All these financial crises, what is the arc?
Well, the arc is that you start out with XYZ business model, and then for whatever reason things start to go wrong, and then people decide, instead of fixing it, they drink some KoolAid and they say you can grow out of your problem. The KoolAid of 2007 was home prices will never go down, which was ridiculous from the beginning. And then you have the crooks come in. That's the next thing. That's the next phase. The crooks coming in are kind of the canaries in the coal mine that things are already have run amok. And then you have a point where it's unsustainable anymore and no one can hide it anymore, and it all kind of collapses. That's why these financial crises seem to happen all of a sudden. Like one day they had great balance sheets, the next day they don't. And that's because people put off the day of reckoning. The day of reckoning happened months, years before. They just didn't recognize it in an accounting sense. So that's why these things seem to happen all of a sudden. But it begins as a good thing. It starts to go awry because maybe factors out of their control. People do stupid things to try to keep their jobs and keep the companies going. You get the crooks coming in, and then it becomes unsustainable and collapses. And then the question is, okay, does this pose a threat to the entire economy or not? Are we going to have a bailout or not? Then you got to follow the bailout money. How's it spent?